are discussing about redemption of debenture. So to revise, what do you mean by redemption of debenture? Repayment of the debenture amount to the debenture holders, right? We are going to repay it, and also we are going to cancel off those debentures, right? Whenever redeem, what happens? The liability decreases. At the same time, when you pay, the asset also decreases. As simple as that. So redemption could be done in many ways. Majorly two. One, after the expiry of the term, after the expiry of certain term or annual drawings, we are going to redeem it. Or we will, whenever the company has the money, whenever the debentures are listed in the market less than the price at which they plan to redeem. For example, we plan to redeem our debentures at rupees 110. Now in the market debenture value is 108. Straight away, if the company has the money, what they do is they will go to the open market, they buy the debentures, they cancel the debentures. So they can save around 2 rupees, no? Yes. So that is your open market purchase and cancellation. Okay. So there are certain provision relating to redemption of debenture you should keep in mind. That is all the unlisted companies, only unlisted companies, okay, other than NBFC and HFC. So HFC and NBFC, this provision is not applicable. So all the unlisted company other than HFC and NBFC should maintain debenture redemption reserve. It is not like redemption of preference share, where after redemption you are going to create some provision. No. Here you should create when you issue the debenture. Here you should create when you issue the debenture. It will be reversed after the redemption of debenture. So the reserve what you have to create when you issue the debenture to the extent of 10% of the face value of the debenture issued, or 10% of the debentures outstanding, right? 10% of the debentures outstanding, that reserve is known as debenture redemption reserve. Okay, that should be created out of free reserves, and all the unlisted company other than HFC and NBFC should create this reserve. Clear? Yes. Later, there are certain few companies which, as per the act, they should keep certain money as an investment. Keep certain money as an investment for the purpose of redemption. See, this reserve or the investment you cannot use for any purpose other than for the purpose of redemption of debenture. Okay, the money which you want to keep for the purpose of, the investment which you want to keep for the purpose of redemption, that is known as debenture redemption reserve investment or investment of debenture redemption reserve. Few companies are required to invest, right? Invest. Which are those companies, sir? All the listed company other than your banking company, AFI, FI. All the banking company other than your all the listed company other than your banking, AFI and FI companies. Clear? And all unlisted company other than your normal HFC and NBFC should maintain 15% of, here you should be very careful, 15% of amount of debentures redeeming during that financial year. For example, in the year of 20, give me a second, in the year of 2023-24, okay, you are planning to redeem 10 lakh debentures. Then by 30th of April 23, you should create 15% of this 10 lakh. 15% of this 10 lakh, that is rupees 1,50,000. So much you should invest. So much you should invest, either in the government treasury bonds like that. Okay, keep that thing in mind. But DRR, sir, DRR on the outstanding amount. For example, you have 1 crore debentures. Out of that, 10 lakh you are planning to redeem during the year. So DRRI required is just 1.5 lakhs. Whereas DRR is required on the outstanding amount, which is a 10 lakh rupees. Got it up? Yes. So all the listed company other than the banking company, AFI, FI and all unlisted company other than HFC and NBFC should maintain the DRRI or should invest in the DRRI to the extent of 15% of the debentures to be redeemed during the financial year. Correct? And one thing you have to remember, in case of convertible debentures, DRR and DRRI should be created to the extent of non-convertible portion. For example, let's say you have 10 lakh rupees debentures, in that 30% is convertible into shares. In this scenario, 10 lakh into 30%, 3 lakh rupees, on that no DRR or DRRI is required. Remaining 7 lakh, on that we have to create a DRR and DRRI. Okay. And at the time of redemption, always keep this thing in mind. At the time of redemption, if any DRRI is there, that should be sold. If the question is silent also, you should sell. Sir, at what rate, sir? You should sell it at book value. You should sell it at book value. And DRR balance relating to that redeemed. For example, DRR you have 10,000 rupees because debentures are around 1 lakh. Now out of this, if you are redeeming 50,000 debentures, no, 5,000 only you should transfer to GR, General Reserve. And DRR should be created out of free reserves only, okay? DRR should be created out of free reserves. You can't use your CRR, securities premium, blah, blah, blah. So, how much you can write, reverse it, or you can transfer to GR to the extent of value of redemption. Okay, to the extent of redemption, you can transfer DRR amount to the General Reserve. Clear? Yes. So, open market purchase and cancellation. Here, debentures to be purchased and immediately cancelled against the liabilities. Debentures we should purchase. That time, for that moment, we treat it as a asset. Later, immediately we should cancel it off against our liabilities. Okay. You can purchase the debentures from the open market at two prices. One is price excluding interest, price cumulation of cumulative interest price, CIP. So, if you bring it at excluding interest, which means whatever you are paying in the open market. For example, if you are buying the debentures at rupees 105, whatever you are paying 105, it will be everything towards the cost of the debenture. Okay. By paying 105, also you are going to pay even accrued interest. You are going to pay accrued interest. Let's say around rupees 6. So overall you are going to pay around rupees 1011. Clear? 1011, out of which 105 will be towards cost, 6 will be towards interest. So if the question tells it is a X interest price, then try to understand whatever you are paying, it is everything towards the cost of the asset. Whatever you are paying, everything towards cost of the asset. If at all it is CIP, then the price will be 111. Price will be 111. We only have to divide. We only have to divide between cost and interest. We only have to divide between cost and interest. So, interest how to compute? Interest how to compute? Very simple. We have to take face value of the debentures bought into rate into last payment of interest. For example, we are buying it in the 31st March from the open market. Last payment of interest was, let's say, 31st October. Last payment was 31st October. Now, we have to calculate interest for accrued interest only. That is November, December, January, February, March for 5 months. Okay. We'll compute the interest for 5 months and we are going to reduce it from the whatever we paid. Let's say for 5 months interest came to 7 rupees. Now, we are going to reduce it from 111 so that we will get 104 and 7. 104 will be cost of debenture, 7 will be interest. Okay. So, X interest price, debenture price will include only cost of debenture. Whole purchase price shall be cost of debenture. Debenture interest to be calculated separately and to be paid in addition to the debenture price what we are paying. Correct? If it's a CIP, debenture price includes accrued interest. So debenture price we are going to divide it into two parts, cost of debenture and accrued interest of debenture. How to calculate the accrued interest? Face value of debenture into interest rate into period from the last date of interest till the date of purchase. Okay, sir, what are the journal entries? Very simple, people. Whenever you create a DRR, I told you have to use the free reserves. If the question is not telling which are the free reserves available, just debit the P&L. Just debit the P&L. So for the creation of DRR, entry will be free reserves account debit to DRR, because one reserve will fall, called as free reserve, one more reserve will increase, called as DRR. Both are in the capital in nature, so straight away increase in the capital credit, decrease in the capital debit. If at all you invest, normal investment entry, investment account debit to bank, there is nothing but here we call the investment as DRRI. If at all you purchase from the open market, as I already told, cost will be treated as an asset, cost of acquisition, the cost of debenture, 105 in our example. The 6 rupees will be treated as an interest what we are paying, correct? So own debentures account debit, interest account debit to bank account. Own debentures account debit, interest account debit to bank. Because whatever you are paying 111, you are not only paying towards the debentures, you are paying towards interest also. If you don't purchase that also, you have to pay the interest now later on. That's the reason we are going to do that. And when you do that, you have to cancel it now. So while cancelling, always remember, if at all the cost of your investment is more than the face value, it will be loss on cancellation. If at all your cost is less than the face value, it will be gain. For example, the cost of your debentures what you bought is 96, the face value is 100, then entry will be, of course, our liability will be cancelled. So debenture we are going to debit. Share capital or debenture, always it will be debited with face value. So debenture account, we are going to debit 100 rupees. Two own debentures, because that won't be any more asset. We are cancelling it off. Two own debentures, 96. Two profit on cancellation, 4. If at all loss, it will be debited. Done? Okay. Then you should write it off that loss or profit. If at all after certain period, if you are redeeming, normal entry, debenture account debit, premium on redemption of debenture account debit to debenture holders account. Later, if the interest is accrued, you are going to treat the entry as or pass the entry as interest account debit to debenture holders. Later, together you are going to pay it off to the debenture holders. So the entry will be debenture holders account debit to bank account. Correct? So when you sell the investment, investment account should be credited because it is a decrease in investment. Bank account debit to investment account, there will be profit or loss on sale of investment. Normal. Transfer of DRR to the GR, DRR account will be debited because that will be decreasing to the extent of redemption, GR account will be credited. Correct? And there might be a conversion option, that is debentures can be converted into shares. Correct? Debentures can be converted into shares. So entry will be, first we are going to transfer it to the debenture holders, whatever we have to pay. Later debenture holders, whatever consideration we are giving. If at all we are giving shares, to share capital, to premium. If at all we are giving some cash, to cash. Okay? And no company basically can issue the debentures irredeemable. It should be redeemable. Basically, secured debenture should be redeemable within 10 years. If at all it is relating to the infrastructural activities, then it will be 30 years. Correct? And one more thing, conversion, how to calculate? Very simple, people. Question will talk about two things. One is people opted to convert, people not opted to convert. Out of the outstanding, we should divide it into two. Somewhere we solve, no? That is important. Examination point of view, this is important. See here we have around 10,000 debentures. In the given question, what they tell is, in 10,000 debentures, the face value of 2 lakh, which will be around 2,000 debenture holders. They want to convert. They don't get 2,000 shares. Try to understand. They want to convert. Remaining 8,000 people don't want to convert. So first what you should do is, 10,000 you should divide it into two parts. Okay? 2,000 and 8,000. 2,000 and 8,000. Later what you should do is 8,000 everything is paid in cash. Correct? 8,000 into whatever you have to pay, redeemable value 105. Correct? Around 8,40,000 we are going to pay through cash. Done. Remaining 2,000 is there, no? For them how much we have to pay, that we should calculate. 2,000 into 105, 2,10,000. The 2,10,000 consideration, we are satisfying how? Conversion option given for the 30%, no? So 2,10,000, 30% we are going to issue the shares, remaining 70% we are going to pay through cash. So 2,10,000 I am going to divide into 30 and 70, 63,000 and 1,47,000. So 63,000, you should divide it by issue price, not face value, to arrive at a number of shares to be issued. Net proceeds. So you will get the number of shares to be issued as well as how much cash to be paid. This was all about redemption of debentures. Clear?